Hey everyone, this is Joseph. Such an exciting day today. So I put out a new piece today about the banking sector. It's called Hidden to Market. And so I thought I would walk through it with you guys to help you understand what I'm thinking. So first of all, I want you to know that the banking system today is really, really different than it was before the great financial crises. Now, when I look at the market right now, I see some people panicking, and there's really no need for that. So let's go over a couple big points here. So pre-great financial crisis, the banking sector was not super highly regulated, and there was a lot of bad management going on. So I'll give you an example. So pre-great financial crises, banks didn't really have any liquidity requirements. So they didn't hold a lot of cash or liquid assets on hand to meet potential withdrawals. After the great financial crisis, everyone thought that was a bad idea, and so there was a whole bunch of regulations to make sure they do. Now let's look at this first chart here. Now this first chart here shows the percent of banking sector assets that are high quality liquid assets. Now notice that pre-GFC, it was around, say, 15-20% of the banking sector. After the GFC, it's about 30-35. Another note, let's say pre-GFC, the banking sector as a whole held only about $50 billion of cash on deposit at the Fed. And this was a policy choice by the Fed. Today they hold $3 trillion, so big difference. And on top of that, there are really tons of regulation that basically make banks kind of boring, especially the very big banks. They're basically socialized businesses. That being said, this big global regulatory framework that we have now, called Basel III, doesn't cover all the banks. Some of the smaller banks fall through the cracks. And so you could have some problems with the smaller banks. But what's really important is that smaller banks are not systemically important. During the great financial crises, we had Lehman Brothers fail, and Lehman Brothers was intertwined with everyone in the financial system. So when Lehman Brothers failed, it basically took everyone down. But these smaller banks, regional banks, they're not really financially connected, and honestly, they're basically like big local banks. They're not super sophisticated. So there's really no fallout from a, financial system perspective. So that's one thing to keep in mind. Now, with that being said, in order to understand just why Silicon Valley Bank failed and why I believe that it's really because of exceptionally poor management, I think it's useful to think about the basic business model of a bank. So a bank, as we all know, they have short-dated liabilities and longer-dated assets. So if I'm a depositor and I have $1,000 and I deposit it into Silicon Valley Bank, I'm lending Silicon Valley Bank $1,000. And Silicon Valley Bank is borrowing money from me. I can go and I can take that $1,000 back any day I want. So the liabilities are short-dated. Silicon Valley Bank, on the asset side, they can do all sorts of things. They can go and make mortgage loans, they can go and they can buy treasuries, and so forth. So a bank's basic problem is to make sure they have enough assets on hand to meet redemptions from depositors. So this is a very basic problem. It's basically a liquidity problem. Now let's look at this from the asset side and from the liability side. Now, from an asset side, a bank can meet these potential withdrawals by, one, holding high-quality liquid assets. So that's just cash on deposit at the Fed, or it could be treasuries or agency mortgage-backed securities. These securities are very liquid. So if a bank ever had, let's say, a huge demand for cash from its depositors, they can easily sell these securities, get cash, and meet with redemptions. The bank also has a lot of other assets on its balance sheet as well. It can make a lot of corporate loans and a lot of mortgages. These assets are not as liquid, but that doesn't mean they can't be converted into liquidity. So if you're a bank and a lot of people are asking for their money back and you don't have any high quality liquid assets, what you can do is then you can go and you can borrow from the Fed or Federal Home Loan Bank using these less liquid assets. So really, if you're a bank, there's a lot of support for you to have enough liquidity, provided, of course, that your assets are valuable. Now, that's where the problem comes. Now, if you are a bank and you have a whole bunch of loans, the value of these loans, the value of these securities go up and down depending on market conditions. When the Fed is hiking rates, that usually puts downward pressure on the asset values of all your securities. And you can see in this graph here that it was particularly harmful for the asset values of Silicon Valley Bank. Silicon Valley Bank, unlike basically anyone in this peer group, all these banks are their peers, they're regional banks that have about $200 billion in assets. Silicon Valley Bank basically purchased a whole ton of securities. They had $200 billion in total assets, but of that, $120 billion were in securities, long-dated securities, so those that are sensitive to interest rates. All these other guys, they purchased securities, yeah, but they also mostly made loans. Now, to be clear, when interest rates go higher, that also impacts the value of loans. But there's no market for loans, so you don't really know what the value of those loans are. There is a market for securities, and so when they have regulatory filings, it's very clear that Silicon Valley Bank owned a lot of securities and they had gone down tremendously in value. So looking here, it looks like their unrealized losses on their securities portfolio rose to about 8% of their total assets. So they had basically $20 billion in losses. Now, when you're talking about an asset price like a treasury or an agency MBS, there's no credit risk. So even though the asset value goes up and down with interest rates, ultimately they're going to pay off. So if I bought $100 worth of treasuries, Fed hikes rates, the market value goes down to $80. If I hold that treasury security over time, the market value will converge to the face value and I'll get paid down. So that's why you have to be very careful here when you look at the asset side alone. It looks like they have huge losses and maybe they're insolvent, but if they hold those assets over time, their values will go back up and everything will be okay. So you want to be careful when you think about solvency in that way. But what is clear though, that if you have an emergency liquidity need, the amount of liquidity you can raise is really just based on the market value of your assets. So if you have large unrealized losses on your assets like Silicon Valley Bank did, you don't have to mark to market and you're not necessarily insolvent. But if you sell them to raise cash, you're not really going to get as much cash as you thought you could, because you have unrealized losses that become realized losses. So you have to be very careful as a bank to manage your assets so that, across the interest rate cycle, they won't just decline too much. And most banks, what they do is they use derivatives to manage these interest rate risks. And to manage credit risks, they can also use derivatives as well. Silicon Valley Bank did not do any of that. Now the second part, and this is really what kills a bank like Silicon Valley Bank, is liability management. So we have assets here. We want to make sure they have enough market value such that if I needed to pawn them for cash, I could do that. But another way to make sure that I have enough liquidity is to make sure that the demand for liquidity is not going to be very volatile. Let me explain. So if I'm a bank, I have all sorts of depositors. And I want to make sure that they don't all come and ask for their money back at the same time, because that gives me, I might not have enough assets to meet that. So what I can do, and what a well-managed bank would do, is that they would try to manage their liabilities through a number of ways. One is contractual. For example, instead of having a lot of checking deposits, I offer my depositors CDs, maybe a certificate of deposit that matures in 1 year or 2 years. If I do that, then I know there won't be a run on my bank, because those guys, they can't withdraw their money until the expiration of the CD. Another way that I can manage my liabilities is that I can make sure that the people who deposit money at my bank are people who are not likely to run, specifically retail depositors. So a retail depositor is covered, so in the US, your deposits at a bank are covered by up to $250,000 FDIC insurance. So usually that's much more than any retail depositor needs. So a well-managed bank, they will have a whole bunch of retail depositors whose deposits are protected by the $250,000 FDIC insurance. That means that they're less likely to run no matter what happens to the bank, because they know that they're deposits are safe. What you really don't want as a bank is a lot of hot money. So you can, like a big company or a big investment manager that puts, $100 billion in your bank, and then the first sign that something's wrong with your bank, they're gone. Because they don't have insurance, they got to be careful. Now let's look at this chart here. This is the percent of deposits that are uninsured across the regional bank peer group. Notice what really stands out here. So Silicon Valley Bank, almost all its deposits are basically owed to wealthy people or companies. They had no retail base. They were a bank basically for largely businesses and rich people. And that made their deposit base very volatile. There's so many ways a bank could have done to manage this differently, and look at all their other peers. All their other peers, they know better. But these guys, they just did a terrible job. There's really no way around this. That's not how you should be managing your liabilities. And so that's basically how it unfolded. You had a whole lot of hot money invested in Silicon Valley Bank. They all kind of got spooked, and maybe there was reason to be spooked. Again, Silicon Valley Bank, highly exposed to the tech sector. Maybe their loan book isn't very good. So when they all took their money out and they ran, basically, Silicon Valley Bank could only do basically two things. One is that they can sell their securities at a loss, which they did, or they can go and get an emergency loan from the Fed or the Federal Home Loan Banks. But then those loans are based on market value, and the market value of all their assets had gone down. So honestly, they were kind of stuck there. There was really nothing they could do. Now let's think about that as a example for what might be happening in the broader market. So in the broader market, the Fed has been hiking rates a lot. So basically the asset side of all the banks has been going down. So they've had unrealized losses. Now, before you rush and think that, oh my gosh, the banking sector is insolvent, you got to look at this from the liability side as well. Now, let's say I put $1,000 into a local bank. The local bank gives me 0% interest. All deposits basically pay 0% interest these days. Now, in theory, I can take my money back out of that bank anytime I want. So it's like an overnight loan. But in practice, if, most people, including myself, they keep their money in the bank and they put some in sometimes and they take some out sometimes. But usually you leave some in there. So in practice, although I can take my money out of the bank anytime I want, I usually leave it there. So it's kind of like a long-dated loan to the bank that doesn't receive interest. It's kind of like a zero coupon perpetual bond. And when interest rates go higher, these liabilities decrease in market value as well. So yeah, higher rates push down the asset side of a bank's balance sheet, but they also decrease the value of its liabilities. After all, if you're looking at most banks, they still offer a 0% interest on checking accounts. So all in all, it's not super clear to me that there's tremendous insolvency in the banking sector. And also, if you're a well-managed bank, you're going to be fine. Look at JP Morgan today. Although First Republic is down almost 50%, the big banks, they are fine. Now, one last thing I want to talk about is this brand new bailout facility by the Fed. So the Fed yesterday unveiled this new facility that's willing to provide emergency loans to the banking sector. This is, in my view, the biggest bailout to the banks since the great financial crises. And let me explain. So if you are a central banker, your standard, every central banker knows this way of operating is you want to lend to solvent banks against good collateral and at penalty rates, because that's how you encourage good behavior. You want to be there as a backstop, not there to subsidize the profit of a bank. Now, this new facility basically doesn't do any of that. Any bank can borrow from it. It doesn't matter if you're solvent or not. And here's the thing that's really, really crucial. You borrow based on face value and not market value. So let's say that you bought $100 in treasuries, Fed hiked rates, treasuries are worth $70 now. you're supposed to only be able to borrow against market value. But with this new facility, you can take that $70 of collateral and borrow $100. So you're borrowing based on face value. And no central bank ever does anything like that. It is a tremendous giveaway to the banking sector. And to top it all off, the rates that these facilities lending at, it's OIS plus 10. So it's basically around market. I suspect it's probably a little bit below market. So really, the Fed just rolled out this huge facility to basically bail out all the banks, especially those who, like Silicon Valley Bank, just kind of YOLO'd into long duration assets. And this is really revolutionary because as a country, we had a banking crisis. We spent 10 years and a whole bunch of regulation to try to make it stronger. But at the end of the day, instead of letting the system work, we just kind of bailed everyone out. All right, that's it for today. Thank you for watching.